Cue the music. Hello. Every so often, once in a blue moon and or every other Thursday of every other month, the SEC give us a gift. They give us 13 Fs, 13 Fs, where the world's most famous underperformers of the S&P 500 tell us what not to do. And that's what we're going to do today. Figure out what not to do, starting with all-you-can-eat buffet. Now this man added Ulta Beauty to his portfolio, and in the words of Tony Cheese, will always buy makeup. Buffett knows this, your wife knows this, and that's why he's a billionaire and you're stuck paying child support. William aka Will aka Bill aka Alpha added Nike to his portfolio. This is your bull case right now, Bill. This is your bull case. And everybody's favorite bear, Michael Burry, continues to support communism by buying China.
You're completely sure of the math.
Look at him. That's my quant.
Your what?
My quantitative. His name's Yang. He won a national math competition in China. He doesn't even speak English. Yeah, I'm sure of the math.
Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and guys, what a day. Risk on fever. The last time I saw this much green, I was in the Amazon rainforest. Absolutely green day, driven by the right stocks in the right names, stuff like Nvidia, the big boys, semiconductors, Apple, Google, Meta, discretionary, Tesla up 6%, Amazon up 4%. They really propelled the discretionary space forward. But there's a lot going on in discretionary, from Starbucks to Walmart to Home Depot, Victoria's Secret, Chipotle as well. There's a lot going on in this sector right now. And I think we're at the early stages of quite a bounce because, you know, the majority of this sector hasn't done too well this year, but coupled with risk on fever in cyclical assets, we saw defensives, healthcare underperform today. Same with utilities as well as staples, at least the defensive component of staples. The growth component of staples was actually green. And this is a risk off sector. This is risk on. This is risk on. Risk off got sold. Risk on got bought. And that's because economic data came in very strong today. The reason why markets actually had that 10% correction was simply because of the macro. The bear case was the macro is weakening. The Fed waited too long, but as we got more and more data in the last couple of weeks, the data has continued to surprise to the upside, and today was no different. We got initial jobless claims beating expectations, 227,000 against 234, and then we actually got retail sales 1% versus 0.3. That's the month over month growth figure, and then autos 0.4% against 0.1. So the consumer looking very, very strong, and July's weak labor report is now looking like an outlier simply because of temporary layoffs. And so the Fed are not cutting to save the economy. The Fed are actually just now cutting to normalize policy because yes, we had a couple of weeks of bad data. It happens. The data has come in strong. Disinflation is well underway. Growth to remain robust. I think we should see stuff like the Fed's GDP now tick up over the next couple of days. And this is why stocks rally today. The market knows rate cuts are coming. The question is simple. Why are the Fed cutting rates? If the economy is bad, they're cutting to save the economy. That's not good for stocks. But if the economy remains robust, if the economy remains strong, they're cutting to normalize policy. Stocks do very, very well in that scenario. And that was the sentiment behind today's momentum. The discretionary space rallied today. Retail sales were strong. The unemployment figures were fairly upbeat, signaling a tight labor market. Discretionary outperformed. Tech outperformed. We also saw materials, industrials, energy, staples, financials. They were all up 1% here on the day. And then these defensive sectors, healthcare, utilities, real estate, they were actually in the green today. At least healthcare was. Utilities was flat, real estate down 0.3%. But this is exactly what you want to see in risk on environment. You want to see defensives underperform, maybe even get sold, and you want to see the money rotate into cyclical assets. And that's exactly the trade we saw today. And it trickled its way down into the small caps, mid caps as well. We actually saw small caps were the best performing segment across the value, core, and growth segments. In fact, small caps were very upbeat. Apart from large growth, small caps outperformed, and this tells us it's literally risk on. When you see growth outperforming and small size outperforming, and we even saw continued bullish momentum in the global markets. I mean, China was here in the red. I think that had to do with some of the earnings reports, but Japan was green, Australia was green, New Zealand was green, Europe was very green, and then North America super green as well. South America too, not quite as bullish as North America, but yeah, a lot of the flows stemmed from the reports we got in the US market, and monkey see, monkey do. And guys, August is officially turning positive for a lot of sectors. Look at the S&P 500, now positive for the month of August. Look at technology up 1.02%. Staples and healthcare still the outperformers, but that's because their drawdowns at the start of the month weren't as steep. I mean, look at something like XLY, XLK, the discretionary space and the technology space. So essentially Amazon, Tesla, Nvidia, Apple, Microsoft, right? They were down very close to 9%, closer to 10% in early August. We're now at August 14th, August 15th. Some of these sectors, at least AXLK, the tech sector, is up 1%. The discretionary space is actually still down 2.56% on the month. Same with materials, energy, as well as financials. But considering where some of these sectors were, I mean, stuff like energy was down 5% at one point. XLF was down 6% at one point. Very strong turnaround. Essentially, Bears was saying this is a bear market rally. No, this is now just a bull market rally. And the price action we're seeing in the S&P 500 is looking very, very constructive. This is the year-to-date chart, guys. We put in a low, higher low, and now this is looking like a higher low in the context of making highs, new all-time highs. We actually went and broke some key levels, while we also did some very constructive things on the breadth front. This is the advanced decline line for the S&P 500. We're pretty much at new all-time highs here for market breadth. As the market has rallied and not quite made all-time highs, market breadth has made all-time highs. And then you actually look at something like the RSI. We're not even overbought yet, and this rally still has legs to run. And we actually did go ahead and close above key levels. Now, we didn't close above the highs right there, but we did actually close above closes. So that was the close of the red candle, that was the close of the white candle. We closed at 55.43. Very constructive price action if you ask me, and this is coupled with not just breadth in the S&P 500 but across all segments of the market. The IWM was up 2.59%. This again is looking like a higher low relative to this low, an equal low relative to this low right here. And we can then go ahead, attack the highs at 227, 230, and then all-time highs. Looking at the RSP, we are just a percentage point away from new all-time highs. 1.56% in the RSP. Very constructive price action. The same is true with mid caps and the Nasdaq 100, the QQQs, also retaking some very, very critical levels, looking very strong. If we actually pull up the advanced decline line for the Nasdaq 100, looking exactly the same like the S&P 500 and not even in overbought territory. And this market has room to run. If we actually see follow through into tomorrow's trade, don't be surprised into next week. The market looks very bullish on a technical basis right now, making higher highs, higher lows in the context of making new all-time highs. That's bullish. I don't know what is more bullish than this going into a cutting cycle with robust growth, a tight labor market, and the consumer hanging in there. You want to hold equities in an environment like this. Now, looking at the S&P 500 and Gamma moved exactly the way we expected it to move yesterday. So what we actually saw was the core resistance in the S&P 500 Gamma levels moved up to 75.50 right here. This was actually the previous core resistance. So we saw a huge move up in the core Gamma resistance. The put support stayed at 5,300. We saw the Gamma flip move to 5,500, and the S&P 500 actually open in positive Gamma ever so slightly and make higher highs, higher lows in today's trade. Now, this is a very, very bullish candle. We see a gap up and go. Essentially, you gap up and then you make the day's lows and you never see those lows again. A tiny wick, but it's inconsequential because that is just a bit of zero DTE sellers here at the end of the day, just dealers hedging their books, getting out of trades, nothing too substantial. As long as we're in positive Gamma, you know the name of the game. If we're in positive Gamma, above the Gamma flip, we look to the core resistance, and our target right now is the 57.50, but we do have to look at lower levels first. And I think the very first key level that we do want to go and take is the 55.85. I think we need to aim for that next week, and then from there we can go to new all-time highs at 56.70. That's the game plan right now. So it's very, very simple. We're buying dips, selling rips to the 55.85 area right here, then the 56.70 area, new all-time highs, and then we'll aim for the 57.50 area. If the market is to give some back tomorrow, as long as we stay above the 5,500 area in the S&P 500, that's bullish. And what's really constructive right now is actually the price action we're seeing in the after hours. Look at the IWM. flat in the context of a day that's up 2.59%. Qs are down ever so slightly. The R fairly upbeat, and the SPY is pretty much flat as well. Very interesting action here in the after hours. And then looking at the performance of the rest of the market, we actually saw yields rise across the spectrum. The 2-year yield, the 10-year yield, and the 30-year yield were all up about 1%. As a result, TLT actually fell 0.81%. Stronger yields just means stronger economy. This is actually really good, but if yields continue to rise, it's probably going to weigh on smalls. But we do know that rate cuts are on the table. The dollar gained a lot. It was up 0.5%, but it did actually fall at the start of this week. So it's sort of just paring a lot of its losses. Bitcoin continues to see selling pressure, and commodities were fairly upbeat. Gold was up 0.4%. Silver was up 3% today, a strong move from silver, and crude was up 1.53%. Looking at some earnings today, we had a pretty big day of earnings here on Thursday. We had Alibaba report earnings. Their earnings actually came in quite lackluster. They were down 4% in the pre-market. They were flat on the day though, so rallied off the lows here, but they actually beat on EPS, missed on revenue, and the market definitely did not like that in the pre-market. We also saw JD, very similar earnings. They actually beat on both the EPS and revenue side. However, their guidance wasn't that great. So I think some of the China woes starting to make its way in some of these consumer stocks. However, not the same when it comes to US stocks. Walmart reported a double beat. They beat on top line, beat on bottom line, and actually raised guidance. You know, Walmart was up like 6%. Very interesting. John Deere roughly did the same, was actually up 6% as well on the day. They beat on both the top line and bottom line and actually increased guidance ever so slightly. I didn't get to look at AMAT's earnings because they reported in the after hours, but they were up 5% today, and the initial reaction on their earnings was pretty much flat. So I'm assuming their earnings came in as the market expected, and we actually had a fairly decent week of earnings. There were a couple of concerning things with stuff like Alibaba as well as Home Depot, but for the most part, this week has had fairly robust earnings in my opinion. Looking at the AA sentiment survey, guys, we're seeing quite a lot of volatility here in bearish sentiment votes. We've seen huge whipsaw action to and from the 20% to 30% range. We saw bearish sentiment decline from 37.5, which is above the historical average, by the way, to 28.9 below the historical average, and that was last week's dip into this week's rip. And we saw a lot of the people that were in the bearish camp jump into the neutral territory, and we saw bullish sentiment stay fairly elevated, well above the historical average. And when you see stuff like this, right, in heightened volatility, that's one indicator that a lot of it's going to be short-lived. And when you get massive short-term dips like we did last week, or in the last couple of weeks, you want to buy those dips because the S&P 500 has very solid forward returns 13, 26, 39, and 52 weeks after the VIX spikes or after we get volatility in the market. The average return 12 months later, 52 weeks later, 14.04% on average. Median returns of 18%. 80% of the time it's higher compared to the average return in the S&P 500, which is just 9.43%, median 11%, and a lower hit rate. When you get volatility in the market, you want to buy the fear because you get outsized returns. The difference between 9% and 14%, that is a substantial amount of alpha. And that's how you really beat the market, by buying on weakness. And at the end of the day, volatility during this time of year is completely normal. This July into August into September period tends to be quite volatile for stocks. The S&P 500 has sort of done the same, had a bit of a pullback. So the S&P 500 following the typical historical pattern, which is just a bit of mid-year volatility. But we do want to buy the dip because the end of year tends to be very, very strong in every single instance. Even when the incumbent president chooses not to seek re-election, Joe Biden won't be running. Kamala is the head honcho of the Democrat Party right now. And when the incumbent does not run for re-election, what we see with the Dow Industrials is that we actually get sideways action from about April, May, June, July into August. But then we actually do go on the end of year run, similar to the way the S&P 500 does. We've sort of done the same here in 2024, and what you can bet on is some form of an end of year rally to ensue, but not without some volatility. volatility first. We are getting a lot of the volatility in this year, but once we par it up, up and away, and as long as the fundamental picture stays the course, in other words, earnings remain strong, and that they have, second quarter S&P 500 surprises come in at about 7%. I know this picture is really bad quality, but this is actually the S&P 500 equal weight basket. So earnings surprise equal weighted is coming in at 7%. Revenue surprise coming in at 1%. Very strong when you look at it in this light. Overall S&P 500 earnings growth year over year is sitting at about 11% right now. Very strong earnings. This is exactly what you want to see in the market. And with the fundamental picture remaining strong going into a rate cutting cycle, 208 basis points worth of cuts are priced in for the next 12 months. Stocks tend to do really well in that scenario. 12-month returns later is about 14%. 24 months returns, you're looking at about 34% from the start of a Fed cutting cycle. This is just really the beginning of the next cutting cycle, and you want to hold stocks if the macro holds up, because rate cuts are just a liquidity driver into the market. And ultimately, the biggest macro driver we have to pay attention to is simply employment, because we know GDP growth is looking fairly strong into the end of this year as well as next year. And we know that inflation is definitely coming down. We got yesterday's CPI report. Very cool, along with a cool PPI report. And that means our focus shifts to employment, because this is causing the market turmoil. It's part of the reason why we actually saw a sell-off. This black line right here is actually the market expectation. This right here was the reported figure. Non-farms missed by a large margin. Now, there was some weather-related issues, but at the end of the day, the data is the data, and we have to take it as it comes. And the unemployment rate moved up to 4.3%. But the unemployment rate increasing may have just been a one-off event, because Goldman Sachs see the direct boost to the unemployment rate from recent immigration trends is nearly at its peak. Immigration caused a huge boost to the unemployment, literally taking jobs away from American citizens. That's so sad. And right here at its peak, immigration actually added 0.7% to the unemployment rate. So pretty much if the unemployment rate pre this figure was 3%, the unemployment rate because of immigration moved up to 3.7%. However, this headwind to the unemployment rate is set to slow in the back half of 2024 into 2025. And the better than expected initial jobless claims numbers we got is actually seasonally what normally happens. We actually see initial jobless claims or employment kind of track flat into the start of the year. Then we see a rise into the middle of the year, and then we actually see initial jobless claims or employment fall. We see this very, very often in 2021, 2019, 2018. Yes, there is some outliers, but normally what happens is we rise into the middle of the year and then taper off as we begin the Christmas hiring. And that's actually what we're seeing in initial jobless claims right now. We see the rise into the middle of the year, the top out, providing a tailwind for equities, the consumer, and the global and the market as a whole. The top and then the steady decline into the end of the year, into the Christmas hiring period, which normally provides a tailwind for equities, the labor market, the consumer, and by extension, the economy as a whole.